All right, let's keep looking at the expected value, and this time through some other claims with both positive and negative outcomes. This here is a list of 3 different claims. Let's start with our first. We're claiming 1 million. A 50% chance to win this 1 million gives a probability weighted value of 500,000. A 50% chance to lose and get nothing gives a weighted value of nothing. And when we add these two together, we get the expected value of 500,000. Now suppose instead we have a 50% chance to win 1 million and a 50% risk of having to pay a million to the other party. 50% chance of 1 million is 500,000. 50% chance of negative 1 million is negative 500,000. Add these probability weighted values together and the expected value is 0. It's again important to note that the expected value is not one distinct outcome. In this example here, there's no way to actually win 0 or get 0. We either get a million or we lose a million, and the expected value is 0. Let's look at one last example. Here we have a 20% chance to win 1 million and an 80% chance to lose 250,000. 20% of 1 million is 200,000. 80% chance of negative 250,000 is negative 200,000. Add these two outcomes together and the expected value is again 0. This isn't a bet worth taking. Sure, we could win a million, but that win doesn't add any value once we also consider the smaller but more likely loss. The greatest benefit of looking at the expected value in litigation and arbitration is that it can be directly compared to an alternative, like choosing to negotiate and settle. If a settlement offer is higher than the expected value of going to court, then it's generally not a good idea to go to trial. Sure, a bigger win might be possible, but the upside isn't big enough to justify the potential downside of losing. Cases can also include non-financial factors like time spent on the dispute, reputational damage or stress, etc. Now these can be costed and included into a model or treated as kind of a premium on top of the expected value. We'll come back to this in a later video. To summarize, the expected value is a single figure that represents all outcomes weighted by their probability of occurring. A positive expected value means the chance and value of winning outweigh the chance and cost of losing. A negative value means the opposite. With the expected value, we can see whether the case is generally an asset or a liability, and we can compare it with alternatives to make better decisions about how to handle the dispute. Now, the main drawback of the expected value is that on its own, it doesn't show the full range of outcomes. It doesn't highlight the really good ones or the really bad ones, or which outcomes are more likely. That's what we're going to look at in the next video.